Welcome back, everyone, to Vox Markets Live. My name is Paul Hill. I'm delighted again to be able to speak to equity analyst and stock market commentator Paul Scott to discuss all things small cap. So welcome, Paul.
Thanks, Paul, and hello to everyone again.
We were just saying just before we came on, it's been a massive manic week on the markets, both sides of the Atlantic, sort of going into either Q1 results or full year results for small caps. But we sort of like dig into sort of corporate results there, Paul. I don't have any sort of quick thoughts on the important findings or initial findings from the competition authorities in the UK about the drug pricing or pet drug pricing by veterinary practice that there's been going on behind the scenes for about last 12 months. But they had sort of like a good positive reaction from one of your stocks, Pets at Home, and also for CVS Group, the pure UK veterinary practice business.
Yeah, I didn't spot the announcement from the CMA originally, but I did notice on my sort of routine screening of the market movers early this morning. I use ShareScope for that. It's very, very good. And I noticed that CVS Group was it's up 13% now, actually. So I thought, right, something's happened, probably CMA. So found the document online, and I did a little write-up on it in my blog today. It was, I think, a 160-page report from the CMA.
Well read.
Yeah, well, I read the first 20. I normally find you get what you need for the first 20 pages. But it basically said it's just an interim update, really. They haven't actually even decided whether they want the vets practices to do certain remediations or not. But basically, it all sounded pretty benign. They seem to be really focusing on this, the CMA, this is, saying that they've had a record number of responses from the public, that there's been a lot of input to the consultation. So it really seems to be about, I think, as the market expected, really, it's all about they just want vets practices to be more open with their pricing, to put their standard prices on their websites. I think the CMA wants a price comparison website to be set up, but there was nothing about forcing any of the major players to demerge or dispose of any vets practices, and that would have been the thing that would have really harmed, I think, the listed. So I think this looks pretty much as the market seemed to be signalling with the recovery in these shares in recent months, that the CMA don't look like they're going to go in for the jugular here. So I think that's definitely reassuring. I was quite surprised, though, that CVS was up so much and Pets at Home was up so little. Pets at Home only went up 3 or 4%, even though it's far more cash generative, and it pays a 5% dividend yield, more than 5%. Pets at Home does. I do own a few personally. And it's got no financial gearing other than leases. So I think of the two, for me personally, Pets at Home is a much better bargain. CVS is highly geared and you get less than 1% dividend yield, but you preferred it when we last discussed this. So what do you see in CVS Group that I'm missing, Paul?
Well, it's basically CVS. I'll get the chart up on Pets at Home as well. Yeah. But the one thing I like about CVS, it's a pure vet practice, and therefore you don't get all the retail stuff and competition in terms of the internet. It's, you've basically got vets who have to prescribe drugs. And what I took from the CMA's review this morning was that the more onerous sort of like requirements that people were fearing, which have been holding the whole sector back and acting as a bit of sort of like a cloud over the market, had disappeared. And if they just basically put, let's be clear about it, if they put just a price comparison website, it's going to be go compare, isn't it? Or buy some shares in moneysupermarket.com. I mean, that would be very, very, very simple. And that's sort of the real horror stories. One was obviously to unbundle some of the vets that previously bought, so that had been a requirement. And then the other one was to put in price controls, and both of those seem very unlikely. They put this big caveat in it saying, actually, we don't want to nail vet practices because they have to basically, because they're physical and they have a customer service, they've got to make a profit. And if you if you basically just have a straight online service, you're not going to get the customer service and they're going to go out of business. So it was quite a sort of, I thought it was actually quite a practical, pragmatic report.
Yeah, I agree. I thought it was well balanced as well, because it said that, look, this is the problem, that the prices of vets have gone up 65% in the last 10 years and general price inflation has been 35%. So prima facie there is something here that needs looking at. But then it's quite balanced. It said, but there are people, you used to just have your pet put down, didn't you, when they got seriously ill. Now people treat them like humans, and they want to will pay thousands of pounds for surgical procedures to keep them going for another year or two. So for that reason, veterinary services are getting more complicated. And so, it was a nice balanced report, but I think the key takeaway for our purposes is these shares are a lot safer now. And CVS, in any case, is now expanding in Australia. I think they've reckoned that they've probably pushed as far as they can go in the UK. And the CMA did say that any future mergers or major acquisitions, they would look at more closely. But the key thing is they're not going to try and undo anything that's already happened. So it's good news for the sector, I think, isn't it?
Yeah, and I think they're still
for shareholders anyway.
No, I think they're still both cheap. CVS Group, I got there's about 14 times PE. Pets at Home to 12.5 times PE. So, and they both got a decent balance sheet. So, frankly, I think they're going to
be CVS. I would counter that. It's got a lot of debt.
But it's about 1.6, 1.7 times EBITDA, but there's quite a bit of
that's a lot to me.
Okay.
But anyway,
but there's a lot anyway. One tip, actually, instead of having to read the first 20 pages, what I did, I downloaded their report and chucked it into Grok, the AI engine, in Twitter.
Oh, that's cheating.
And I know, and I said summarize it, what the key takeaways, what does and it just came out with about sort of 5 or 6 points. That fantastic. That saves me reading.
I'm gonna have to go on a course for AI. My one of my co-writers is an IT genius, Alan Morrison. He's taught me how to make cartoons about shares, which we do every day. Alan normally does them, but I've learned how to do them, and it's quite good fun.
Yeah. Have you been just moving on? Have you been buying anything or selling anything this week at all, Paul?
Yes, I bailed out at a loss on a small position in something called Gemfields. I think the ticker was GEM. Now, the reason I went completely outside my area of expertise, it's a miner for coloured gemstones in Africa, I think. Quite a significant business, hugely profitable in good years, but we might have just talked about it before. Obviously, it's not as affected. Diamonds have finished because of lab-grown diamonds, but coloured gemstones are still a reasonable business. But the thing I particularly liked, it owns the Fabergé brand, which, if the right things were done with it by one of these big branding giants, Fabergé could, that could be worth squillions, couldn't it? It could become, a real top name brand. But anyway, they've done an emergency rights issue, and I've lost a third of my money on it. And you've just got to make that decision. Do we take up our rights and throw more money at this, or do we just hold? Or is this just taking up too much of my mental bandwidth? And my friend and I, who I co-invested with, we just said, look, we're wasting time on this. We've got 700 other companies to look at. So we've ditched them. Unfortunately, as I say, 35% loss. But c'est la vie. You just chuck them out. And I bought, what have I bought? Oh, some Gregs. I bought a few Gregs just to dip my toe in with a little position there. Forward PE is now down to 13, which I think is a sensible price. I never bought into the sort of 20 plus PE on this. It was just overvalued. Now it's dropped into my lap. Mild operational problems, but nothing to justify such a big move down. So I think Greg's is a nice consumer stocks generally. The well-run mid to large consumer stocks, I think, are very good right now. And what else did I buy?
Has he got, just on Greg's, has he got enough pricing power to push through the sort of the NI and the minimum wage increases? I'm guessing he probably has, given it's a good valuable, good value, sort of like affordable treat.
Yeah, exactly. I think it's a bit like the Wetherspoons. I have a small position in Wetherspoons as well. These guys who are 30, 40% cheaper than the competition can slip through small price rises with people barely noticing, because your bacon butty and your cup of coffee will still be dirt cheap. But if you're paying another 10p for it, you probably won't notice. But it puts 3 or 4% on their revenues, which is what they need to mop up. So I think the problems are, and as you've agreed with me previously on this, their main problem is they're not getting people through the till point fast enough. They're fiddling around with these stupid coffee machines. They should do what they do in America, where they just make big jugs of coffee and just press a button on the top of it and out comes your coffee. Not
Yeah.
this fiddling around with bloody machines. So sorry, excuse me. So so yeah, I like Greg's. There's something else I bought as well. I'm just dipping my toe in with small purchases on a few bits and bobs. Oh, I bought some more CLS for my friend's ISA. That's the property thing that's at a huge discount to NAV. I can't remember the others. I have bought a few little things. I top sliced a bit of my Interseed. That went up a lot on a newspaper tip. So I would generally, any newspaper tip that spikes it up 10 or 12%, I just top slice a few. You can always buy them back. Keep my core position, obviously, but I use that to buy. I can't remember, Paul. Sorry. How about you? Have you bought anything?
Well, yeah. I mean, I followed up really from last week because obviously there was a silver lining about our Gentex, and it gave me a reality check that because I've lost a lot, obviously lost a lot of money.
Yeah.
But it did coincide. At least it happened before the money hit in from Equals, or just Equals came in 2 or 3. So I had a big chunk of cash coming in, and but what I did, as I say, it gave me a reality check, and I want to make sure that I'm still sort of like doing stocks and shares until I sort of like hit the, go and start propping up the daisies, So I basically decided to buy a big chunk of bonds, gilt. So I split half of it into traditional long bonds, into 30-year gilts, 5%. And then the other half I bought linkers for the first time I'd ever done, index linked 30-year bonds. And that just means that, they're both sort of like one's pays you 5% per annum until you die, and then the other one is basically index linked until the same time, about 30 years, until I'm sort of like late 80s, and it just really means that my family is okay. So I would say to people, it's that classic sort of thing. When you're young, you can sort of like throw your money around, take a bit more risk, and I take a lot of risk, and it just gave me a big wake up call that. Real problem things can happen, and the last thing I want to do is to impact having sort of like invested for 30 odd years, 20, 25 years, ever put my family in any sort of like I haven't changed the quality of life. So I just basically have underpinned it with some big bonds purchases, which is great.
Really sensible. That very, very good point. I mean, they always say, don't they, as you get older and nearer retirement, have a spread of things in property bonds, so you're not maybe a third of your money are in equities or something like that. So of course I completely ignore that advice myself.
Well, I did one thing I did look, which people want to have a think about. I did actually look at annuities, because annuities now you can get the best rate since 2008, because obviously interest rates have gone up, and so they're not bad, but frankly it's much cheaper and more effective, particularly if you've got it into a SIP, to buy index linked bonds and set up your own annuity essentially, rather than actually paying somebody over your money and then basically allowing them to control it and then pay you, because you get at least another 20% on of value if you do your own annuity, which is what I've done essentially.
No, sounds really good, Paul. Yeah, very sensible.
Well, I don't know if it's really good, but it was quite interesting anyway. I've never bought linkers before. I bought bonds.
Yeah.
Okay, right. Let's move on to subject. To stay on the sort of the animal health, we had big news this week for a company we hardly ever talk about, Genus, which is a sort of like a pig and cow healthcare company. It's sort of like it came out of sort of like supplying prime bull semen about 30 years ago, and now moved into pigs, and has been developing under the radar screen this treatment, cell editing treatment for pigs, etc. And he got FDA approval this week. The shares absolutely rocketed on the back of it. Quite a big company. I don't know what your take on this one is, but clearly it's good news for shareholders.
It is. I think it looks really exciting, actually. I mean, I'll only briefly comment on it because I don't know anything about it, but I had to sort of research this more or less from scratch yesterday. That was it. It went up 23% on this FCA news. I mean, FDA rather. But I mean, people must have been anticipating that to a certain extent, I think. But I mean, it sounds like a game changer. And Pamuel put out a very good note on this with the brilliant title, and this was before the market opened, pigs might fly.
Or do fly.
Yeah. I thought that was great. I love that. But anyway, I mean, it stacks up okay on the existing business. You know, it's on a PE in the low 20s. You've got a small 2% dividend yield, and its balance sheet's okay, about 3.3 times net tangible asset value. So the business stacks up all right on the existing business, but they've now got what Pamuels reckons could be a really substantial new wave of income coming in, an earnings upgrade cycle, and after the FDA approval, other countries will maybe piggyback on it, and apparently it's
no pun intended.
Piggyback. Oh, sorry. Apparently it's going to I think greatly reduce or eradicate some awful disease in pigs, and that's basically all I've got on it. So I don't know anything about it, but I think this looks really exciting. So I upgraded it on my system to green yesterday. But that's not an informed view. So tell me a more informed view, Paul.
No, I think I've exactly the same opinion. I would say that if I was going to, I've never really looked at it in detail, but what's really encouraging is have they actually developed a platform to be able to do sort of like, you know, gene editing in pigs that they can then come out a series of drugs like this, because this isn't just, you know, this one isn't just a one-hit wonder, you know, where you've just got one particular disease area. I bet there's a whole bunch of them, and if they have built a sort of platform that they can do a series of these, that's far more encouraging. So that's where I would sort of like really probe. Is this going to be a one-off hit, or is this actually going to be, it's now rubber stamped the whole platform to be able to generate more treatments like this for different pig and maybe even cow diseases?
Yeah, interesting point. And also what the competitive landscape is. That's the problem I always have venturing into areas that I don't know anything about. You know, I can be completely unaware. I mean, look at what happened with Novo Nordisk with everybody thought this was a license to print money, and then Mounjaro and other Eli Lilly come up with better things, and it acts like an AIM small cap and loses about 2/3 of its value in the blink of an eye. So this thing needs proper research, I think, but just purely on the face of floating over the numbers on a desktop basis, I think Genus, I think it looks really interesting, actually. The sort of thing I probably wouldn't ever have an informational edge on it, so I'd just take a punt. You know, the numbers stack up. I'd have it as one of 30 sort of positions in my brokerage account, and I think it looks promising. People if they haven't done already, I think people should have a proper look at Genus. It looks interesting.
Well, if anybody's got any views on whether they have got a platform there for those type of drugs, then, you know, put them into the chat bot or send me or Paul some information, then we can share it round, because that would be absolutely fabulous.
And one of your institutional guys you interviewed, I remember. Really weird, you know. I always remember exactly where I was when I was walking and listening to a particular company. It's strange. And I was near Regent Canal up in London, stretching my legs on a very warm day back in February, March. We had a little heat wave, I think. And one of your fund manager guys was going on about Genus, and he was saying they've got a lot of interesting things under the radar here. And he was spot on. So I don't suppose you can remember who that was, can you, Paul?
Yeah, I think it was the guy from Stellar Asset Management. But anyway.
Stellar.
Yeah, the guy from Stellar Asset Management. I think is it Stephen English, Simon English?
Oh yes.
I think that was him.
Yes, he's got a slight Liverpudlian accent.
Yes, that's correct.
Yeah, that's right. Yeah, it was him, wasn't it?
Yeah,
he's a smart cookie, actually, I think.
Yeah. Okay, good. Let's move on to another. Let's go to shipbroker Clarkson. Came out with some trading update today. It's been impacted by the tariffs, and it does, as I say, it does shipbroking, and it appears as though the tariffs, not surprisingly, have knocked 10 bells out of shipping rates around the world, but also slowed up a lot of cargo, because people don't know now whether they want to actually import into the States. And there was an interesting report, actually, which came out from Apollo Asset Management over the weekend, saying the first quarter, or they're seeing now, that the US economy has actually really hit a sort of like stall speed. It's gone to zero GDP. And if they don't sort the tariffs out, then you could see a recession in the US in September, in the summer, which is what they were expecting. But anyway, Clarkson's have reiterated that view, that they're very nervous, came out with a profit warning, shares down 10%. I don't know if you've got any views on Clarkson and on the broader macro in terms of what they're suggesting.
Yeah, I don't like Clarkson one bit. My specific beef with them is that the management rewards are unbelievable. You're talking hundreds of millions of pounds a year in bonuses, layers and layers of management remuneration on a scale that I don't think I've ever seen before at this sort of size company. So on that basis, the whole company is basically run for the benefit of the staff and the directors, and shareholders are given a paltry sort of 2 or 2.5% dividend yield, and that's it. So when you dig into that side of things, it's from my point of view, it's just uninvestable. I wouldn't touch it. So what day is it? It's Thursday, isn't it? I'm not getting Thursdays. Oh, here we are, Thursday, 1st of May. We didn't look at this today. I think one of my team had a quick look at it, and they basically said they think it's got off lightly, only dropping 10%. Quite a significant profit warning. Yeah, that was it. They originally said 109 million PBT guidance. They're now saying 85 to 95. So that's a nearly 20% drop in current year guidance. The brokers have slashed forecasts 15-20% as well for this year and next year. And I mean, I think these supply chains are about to break if they haven't broken already. I mean, anecdotally and from some American companies, we're hearing that, there's going to be empty shelves in America, that the retailers are cancelling orders. They don't want to pay 145% import tariffs. So I think they are heading, what I'm hearing as well from friends in America, they're saying the spaghetti is really going to hit the fan big time in terms of supply chains. And that, of course, then, as we saw in the pandemic, that has a huge knock-on effect because to the rest of the world, because all the ships are in the wrong place. I think UK companies could start reporting problems with getting shipping in as well. So I think this has got a good 6 months plus to rumble, don't you?
Yeah. Well, what's quite interesting is the US market just of late has actually been increasing, even though the economy is slowing down. It's quite obvious. You look at every single sort of like key macro indicator, all leading ones anyway, and they're all saying the same. Sentiment's down, business, consumer, freight rates are down, oil prices down, banking shares. Well, they have been doing quite well in terms of the trading, but essentially they're saying greater delinquencies and all this sort of stuff. So everything's been moved as a forward indicator has been moving south. The market's been going up because investors expect the market gloom is economic gloom is going to force Trump to sign some early trade deals, China, Japan being one of them, and then some of in Asia and maybe even the UK. And if we don't see a flurry of these trade deals in the next month, I can see that the market heading south again. But
I think
I think this is it's a man-made issue, and therefore this should be a man-made solution.
I think that's spot on. I think people have worked out now, the market's figured out this guy is an absolute fool. He doesn't know what he's doing. And his strategy of trying to bully the rest of the world hasn't worked. China hasn't blinked. They've just pushed back and said, well, whatever. And I think what I'm hearing anecdotally as well from friends of mine who are abroad and who run businesses that export and so on, they're saying a lot of the countries in the Far East now don't want anything to do with America at all. They don't even want to invoice in dollars to the UK customers. One of my friends says he just got a sterling denominated invoice from his supplier in the Far East, which has never happened before. So I think there's massive underlying damage being caused here, self-inflicted damage, and it'll push the rest of the world closer to China. And what's that? And above all, they want to be respected, don't they? Which is not unreasonable. Actually, just abusing other countries and their leaders verbally, this clown's got to go, I think. I do.
Okay. All right. Let's. Anybody wants to ask Paul any questions? Then please put them into the chat bot, and I'll read them out. We got one from Rising Bull 1985. He's asking about Victrex, which is an industrial company speciality. It does peak polymers. I actually own it. And it's been hit, obviously, because of all the sort of the tariffs and uncertainty about the economic. Because it's a bit of a cyclical play on GDP. The difference is that it's really higher margin and has got some mega products. Peak polymer is very lightweight. It's temperature resistant, both cold and warm, and importantly, as strong as steel. And therefore, it goes into composites like airplanes, EVs. It goes into hopefully going to go into knee joints as well. and it sells, makes very good gross margins. But I don't know what your view on this one. The shares pretty much lackluster, actually.
Yeah, I don't know this one hardly at all, but I remember we did talk about this. I think late last year when it shot up on a relief rally, and I remember you briefed us on it then, and I thought, well, that sounds good, but it's actually all the way back down again, isn't it? So that one, let me look at the metrics on it. Yeah, 7.1% yield and a very good balance sheet. Well, that's enough for me.
Yeah.
So I think, that alone would make me want to look more closely at it. But from what you've said, do you know how much it sells into America then?
It's basically well balanced. It's got a couple of facilities in the States, some in Europe, and they've just built one out in China. So it makes for the local market. So it should be reasonably well insulated on that basis. What it is, it just comes down to sentiment. It's classed in it's in the sector of industrials. If you have an ETF of industrials, then they sell them down because it's that GDP exposure, and this is one which gets hit in it to a certain extent. But it is higher margin. It's a bit of a crown jewel, and they have these mega products, which is what I was interested in. It didn't, when I bought it, wasn't that cheap. It's much cheaper now, and if they can get that growth, the top line gross margin, because I've got a sneak suspicion, I think it's 50-60% gross margins, which for a industrial is fantastic. But I mean, there's still plenty of work to do, though. I think is probably a fair reflection.
Yeah. Oh, I found it. Here we are. I last looked at it on 7th of February when it put out an AGM trading update. The shares were £9.80. And it reported a solid start to the new financial year. It's a September year end, so that would have been obviously October to December. Some caution too, expecting an H2 weighting, which investors generally don't like, do they? Strikingly strong balance sheet, I've commented. And the yield was 6% now. I think we just mentioned it was 7% now, I think, isn't it? So I like companies with strong balance sheets and generous divvies, because they can just ride out short-term downturns. So looks interesting.
Yeah. Okay, good. We've got a question from Gordon Stewart asking about LBG Media, which I think is the website series of them, which does sort of lads humorous commentary about, and they do some for ladies, I think. But it's got a big exposure in the States and likewise in Europe. And I think they came out with a reassuring trading update this week. The shares are trading at quite a cheap, sort of like 12 times PE, good cash on the balance sheet.
Yeah, I like it a lot. We've covered it in my Substack this week. We're basically trying to cover everything, more or less the entire market. And we gave this a green rating on our traffic light system. We think it's very good. So far, we've got egg on our face although we're not trying to predict short-term price movements at all. That's not what we're not tipping. We're just analysing the fundamentals. But we were green on it originally when it was about £1.25 a few months ago. And it's now down to 84p. And there's nothing within the company fundamentals that justifies that sort of move. It actually put out a good update this week. It's got a confident outlook. It's owner managed. It's got about 20% of the market cap in net cash, real genuine net cash. It's a capital light business model, just running these websites basically. And it can do lots of bolt-on acquisitions for small niche content producers, who are subscale. They can buy them up for peanuts and then apply their expertise on the it's basically all about digital advertising.
Yeah.
It's creating content that then they make, and they seem to be very accomplished at what they're doing. Owner managed again, which I love. A very motivated guy. I think some people may not like the sector. I think some investors might just say, Google can change, or YouTube or whatever can change the advertising metrics at the blink of an eye and shatter their profit. But that did actually happen a few months ago, and LBG got round it within about 2 weeks. So they seem to know what they're doing, and the content is good fun. I mean, it's meant to be for Generation Z, I think. I was
going to say it's the younger generation, isn't it, Paul? Not sort of like old crusties like me and you.
I know, but just to mystery shop them, I I followed LB Lads Bible Group. It stands for. I followed LBG on Facebook, and I must admit some of the content is hilarious.
Yeah. No, it's a bit like pigs will fly. Okay, let's move on. We've got a lot of engineering companies putting updates or results. We had finals from Mpac, the sort of high-speed packaging factory automation business that came out with strong and in-line full-year results and in-line guidance. It did say it's seen a bit of softness in the US, but was holding guidance because it basically, the rest of its business was doing well, and it had about 80% visibility over its 2025 estimates, made up of 55% over its equipment business and 25% over its service business. But what were your thoughts? Trades at roughly around about, it's less than 9 times PE.
Yeah, we like Mpac. The only thing I would say is it has disappointed in the past. So it's been set up really nicely, looked really, really cheap, and then bang, just series of profit warnings. So it's not something I'd want to pay too much for. But we liked this one. We looked at it 29th of April. So that's Wednesday this week, wasn't it? Or Tuesday, I think. We like it. Yeah, we like it a lot. We think it's very good. It's, as you say correctly, it's one of these stocks. There are quite a few of them at the moment, like Trifast and like Carclo as well. Yeah. And Mpac. It's all about margin improvements. They're focusing on driving that operating margin up and on reasonably big revenues. That then gives you lovely operational gearing if they manage to do it. Of course, it's not a gift. Just as a company says we want to raise margin from 5% to 10%, it doesn't mean it's going to happen. So, but yeah, we thought these were good results. The net tangible asset value is negative, though. It's got a bit too much debt. It's done some quite big acquisitions, I think.
Yes, transformational last year.
Transformational, and it needs to, which is a word that scares off a lot of investors. So I think they need to digest them and to pay down some of the debt. But because that was my main concern, I wanted to stay at Amber. But John, my co-writer, one of my co-writers, he said, well, actually, no, the note, I think it's from Panmure's, shows that it should rapidly de-gear now. So on that basis, I got dragged along to Amber Green, sort of moderately positive. So yeah, we quite like it. Are you in the same boat, Paul?
Yeah, no, I like it. I mean, I've actually owned it in the past and stuff. And I think if you look beyond any type of temporary volatility, the move to sort of automation, smart factories, these guys are perfectly placed around the world with facilities in the US, in Europe, and out in Asia, because people want to strip out, manual labor and to bring the unit costs down. And these guys, this is exactly what these guys do. They put the automation in there on the production line to be able to do it. So the secular growth trends plus reshoring in the States, they'll make it. So you might see some temporary noise in terms of the tariffs or delayed. If you do see those, then frankly, as long as you hold it for 2, 3, 4, 5 years, then it should do well because it's right in that sweet spot of automation.
Yeah, and I think they had some excitement about some automated electric batteries product line or something, but that's fallen by the wayside, I believe. I think they're now talking about that as being a sort of closed down project. So
no, it's not. I don't think it's closed. I just don't think it's sort of sparking on all cylinders at the moment, given its electrical. Sorry about that.
Well, we got the we got the impression from their update that was now mothballed. Okay. Maybe we got it wrong. I don't know.
Yeah. Okay. Let's move. You mentioned Trifast. It's basically industrial fasteners business for sort of like industrial products, not sort of consumer products. It's going through a turnaround itself. Shares trade at roughly around about 9 times PE. You've got the Harwood boys in here as for shareholders.
And I think one of them is actually on the board as a Ned.
Yeah, Nicholas, that's it.
Nicholas, but they've got over 30% actually, Harwood and Nicholas personally. So they must have had a whitewash from the takeover.
Yeah, must have done, yeah.
Yeah, no, we quite like this. It's never interested me in the past because it's just low margin, always stumbling and having a profit warning every few years and then it's one of these stocks that seems to be permanently restructuring. So I don't like it. Long term, the track record's been poor for the shares. It's not, something I would want to invest in at all. But as a trade, I think now could be the right time, actually. So for that, because they put the trading update for March year end came out yesterday, is in line. And They seem pretty comfortable about being able to pass on any tariff costs, they said. No clear guidance, though, but the broker forecasts were unchanged. Nice, unusually strong balance sheet with this one again, so you're protected. And we just feel that it's an operating margin improvement story, and where they're talking about quite significant improvements in margin, which then see the forecasts uplifting profits, 25-30% for each of the next 2 years. Well, we reckon we crunch the numbers, we think if they're successful in those margin increases, we could see Trifast shares between £1 and £1.20. But that's the sort of bull case. We don't obviously know if that's definitely going to happen.
Yeah, no, I would agree. I think one thing the market may not have yet seen, because they've talked about increasing their pricing, but if you think about what the actual supply chain is here, okay, they supply mission critical sort of fasteners and bolts and stuff like this into, designed in products. This is, to me, given the tariffs, is a bit like COVID. It's the ideal opportunity to push your prices up, because it's a very small cost in a much bigger, sort of product bill of materials. And I think now this is where everybody's expecting prices to go up because of tariffs. I've got a sneaky suspicion this could really do well, because I think that lock, stock and barrel, they'll push the prices up, and I think they'll get it because people are expecting it. It's like COVID, when you couldn't get products, you just paid the price you expected in price inflation. And I think these guys will do the same because they can.
That's interesting. Yeah, and also in some markets, maybe if they've got localized, but quite a few companies recently have been talking about having manufacturing bases which serve the local market. Yeah, and that seems to be the trick here, doesn't it? Which could well mean if they're operating in America. I don't know if Trifast is in America or not.
Yes, it is. Yeah, it is.
Yeah. Well, in which case they might benefit from the Chinese competition having to jack their prices up. I mean, Temu have put their prices up by about 250 or 350% apparently in America. Mind you, that still means you get a bag of junk for about 12 quid. So, but yeah, you're right. The tariffs could actually benefit local producers and enable them to raise their prices too.
Yeah, good. Got a question from David Ray. What he's asking about one of your favourites, I think, or not. Strix, the kettle control boys, basically. They've had a checkered view. He said, I suspect Paul's not going to be talking highly about them, but obviously the shares haven't done well of late. What's your latest view on Strix?
Well, we did ease a bit. I was red on it. I just think it's dripping with red flags. But I have to say, the latest update, we've always got to be fair. We're not making emotional judgments. We're looking at the numbers. So, it put out 2024 calendar results yesterday, which were in line. Adjusted EPS fell 28% to 6.6 pence. So optically, it looks cheap on a PE of about 6 or 7, but I think you've got to factor in the debt. It's still got a lot of net debt, although it was down 24%. It was still 64 million, which that's 2/3 of the market cap, which takes your PE of 7 up to about 12 if you equalize it. So I don't think it's actually particularly cheap when you factor in the debt. Seems reasonably confident, and expectations are unchanged. It's done a whole series of weird acquisitions that don't make any sense to me. It got into a lot of trouble with debt, which has eased a bit now. So because the problems don't seem quite so pronounced, we've eased up from red to amber red. So, but that's as far as I can go on it. So I've never liked the Chinese side of things and the rather odd decision making. And another example of this, for example, in this latest update, was they said, we're maintaining the dividend, but we can't afford to pay it until December. Why? Well, that again just is a red flag, isn't it? You should just pass the dividend.
They'll pay it in 26.
Yeah, it's crazy. So I don't. It's just got a funny smell about it, this business. So I don't like it. I'm afraid. No, I'd rather steer clear.
Okay, good. So not positive there. There you are, David.
No, right, okay. Not a red either. Amber red is a grudging sort of. Well, it may not be that bad.
Okay, let's talk about a smaller mid cap, which we've never discussed before. Drax, which is basically the UK, one of UK's power stations. It used to be coal, and they had to change the coal power stations into pellets, wooden pellets. Came out with a trading update. Now, the reason why I mentioned this is such that I think it's trading at a pretty reasonable valuation. And given we had a massive power cut across the whole of Europe last week, on Tuesday, I think it was, France, not a bit of Spain and
Portugal and Spain, yeah.
This is now becoming critical infrastructure, and to me, the biggest overhang of people buying Drax has simply been people worrying about it's going to be closed because woolen pellets are that environmentally friendly, even though they're supposed to be renewables, etc. But I was just wondering what your thoughts on this one, because it could be that these sort of like older facilities, even though they are, renewable, etc., just keep on going and play an annuity revenue stream. Especially given, you've got to be a brave politician to turn off a 6% load of your, power networks, which is dependable and reliable, haven't you? You've got to be pretty bullish to do that.
Yeah, but the nutcase we got in charge of energy at the moment would do anything as long as it's net zero, because it's a cult. It's another thing that's become a cult. And actually, when we looked at what happened with Portugal and Spain, really, it's shocking how totally dependent we are on electricity, isn't it? And because we basically hardly ever have power cuts in the UK, I'm sure you and I can remember them from our childhood.
We can,
3 days a week, and mum warming up baked beans on a camping gas stove in the kitchen in the dark. We're so dependent. I think I think the people running most Western countries are horribly complacent about energy security. We're giving up homegrown sources of essential backup energy, like our vast reserves of gas that we've got. We don't have to use it necessarily, but we need it there as backup, I think. And that's a really interesting angle on Drax. I last looked at it a couple of years ago, so I'm not up to speed on it now, but the forward PE is 5.8, dividend yield 4.6, and that's well covered, I think. And you've got nice asset backing there. So if this site is going to have a new lease of life, as you suggest, that could be a very interesting trade, actually, Paul. Yeah, good lateral thinking there.
Yeah, and I think the guy you're talking about, the Minister of Energy, he's into bacon butters, if I remember rightly, from his election campaign a long time ago.
Yeah, I feel generally, without getting too political, I think you want pragmatists running government policy and running the civil service, don't you? You want people who can balance up. Yes, well, of course, we all want a better environment, but not at any price. Because without electricity, our society as we know it, life as we know it, would collapse. In days. So I think the Portuguese and the Spanish have done us a favor, actually, by reminding us just how this infrastructure is vital.
Yeah. Do you know what I did actually? I do Tesco online. They come to deliver me once a week. And after the terrible power cuts in Spain and Portugal, I adjusted my weekly Tesco shop to include 12 bottles of water, because they say that if you run out of electricity, you need bottled water. And I've got none in the house at all. So I just thought, actually, right, okay, this is the time to get some and put it in my loft or put it in the garage.
Do you know what? That's that exact same thought went through my head.
I probably have a run now. Tesco's on bottled water.
Yeah, well, I just had visions of me sort of having to lift the toilet cistern off and scooping out mugs of water from.
Okay, right. Let's move to a bit of software. We got build tech software company Eleco reporting today.
Oh yes, I bet you were pleased this morning. That's one of your.
I just disclosed it's my largest position. I've only held it for 10 years, so through thick and thin. Anyway, the shares are up 9%. They basically beat slightly last year's numbers, but they maintain guidance for this year, which is roughly around about, I think it's about 9% organic growth and another 5 or 6 or 7% on M&A growth. And they've still got plenty of cash on the balance sheet, seeing good demand. I don't know what you had a look at this one at all, one of your guys?
I did. I looked at this one first thing, actually, because we do a trawl through all the RNSs. Anything that says ahead of expectations, we prioritize. So I got my comment on this published at about 7:40 this morning. And not that it matters in the slightest what I think about anything, but you'll be pleased to know for the first time, I think ever, I actually agree with you that the valuation is now reasonable. Now it has gone up 10%, as you say, today. But no, I think the valuation now stacks up, whereas in the past it's had too much jam tomorrow in the valuation. But here we are. So it was ahead of expectations. Cavendish said it was a 10% beat for calendar 2024, which is not bad. That was at the EBITDA level. Now, they haven't upped the 2025 or 2026 forecasts, but I think you can sit very comfortably with those forecasts. I think the risk is to the upside, as they say, that you're probably going to get ahead of expectations updates, so you can relax with this one. PE is 20 times, or it was first thing this morning, it'll now be about 22 times on the calendar 24 results, but you can probably forward that to a PE of about 16 or 17 for the current year, which is perfectly reasonable. Very nice organic growth. I don't think they've acquired anything, have they, or was it all organic?
No, they made a couple of acquisitions, but it's 9% organic sales growth. But they did ARR growth. I think it was about 18%. 77% of their revenues is recurring, so highly predictable.
Yes, that's right.
And then they had 109% net retention rate with customers, which means they're upselling, which is excellent into clients. And one thing which I thought was absolutely sort of like encouraging as total upside. Okay, today, which I don't think anybody's really seen and processed it yet. Or last night, the America signed a minerals deal with the Ukraine to rebuild it. Okay, they bought a company called Vertical Digital, based out of Romania, that covers all of the Eastern Bloc, including places like Romania when they can get in there. These guys do build tech software to help organizations, civils, flats, commercial property, all that kind of stuff. Their team, their commercial team with Vertical Digital, going to be perfectly placed to help that whole reconstruction. And I'm sure if they've got that money now sorted, or it's going to be sorted, it'll take years, but they could be in the right place at the right time. So they traded about 2.5 times sales. Their competitors trade at around about 9 to 11 times sales. It just shows you that if there ever somebody comes knocking, then it's going to go for a much bigger number, no doubt about it, because it's nearly near enough 90% gross margins, these things.
Yes, I think this is very good. The numbers today really did strike me as, this is home and dry. This is a nice growth story. It seems to be well managed from what I can tell. And, there's a reason when you get this growing annualized recurring revenue for these software companies, there's a reason that's happening. It's because the product's bloody good. It's got to be. Otherwise, they wouldn't be showing these sort of growth metrics. Yes, helped a bit by acquisitions, but not. I bowed to the inevitable here and went from where I've been stubbornly at amber for years because the valuation was too high. I've gone up to amber green.
Well, I'm hoping to hold these. I've owned them for 10 years, a decade. I'm hoping to hold them as long as my bonds. So another 30 years, another 3 decades. But we'll wait and see. I would have it as an all-time record for me. Half my life will be owning Eleco shares.
Well, it's an interesting one to put on a watch list. Where when the market throws a wobbler, and there have been quite a few of these really great quality software companies where you've got a 20 or 30% sell-off. Cerillion was a good example.
Yes.
Traxis was another one. We cleaned up on that.
I bet you have.
No, you have. You got the big position in it. I haven't. No, we're not complete numpties. Everything we touch doesn't collapse because we bought Traxis the other day and it's got up about 50%.
Yeah, do you know why? I mean, let's talk about Tracsis because it surprised me. They came out with, let's be clear about it. The shares were trading at £3 last week. They came out with a profit warning, and the shares are now at £4.60 today.
Yeah,
I mean, that's 50% up. What's that about?
I don't know. I mean, it's a strange one. I mean, we did say when we spoke about this, I was in Gozo's. I remember where I was when I was talking to you about it. It's weird. We were saying, look, this thing's probably not going to hit the July forecast. We think it's going to warn on profits again, but it's already priced that in and more. That was the reason we were buying. I think you bought around 350.
Yeah, that's right.
I bought some for my friend Brian's ISA. He foolishly put me in charge of his ISA, and I bought some about £3.15. So he thinks I'm an absolute magician now. He says,
"Well, you are."
Bloody hell, Scotty, what have you done? So, we're very pleased with that. I don't specifically know why the market has reacted. I mean, it's got the look of an institution just dumping indiscriminately, doesn't it?
Yeah, or buy some of them. I have heard on the grapevine.
You took out the overhang, I think, didn't you?
Yeah, I have heard on the grapevine. There's quite a few institutions wanting to get into it. So if that's right, then it just is. I think they just wanted to get that clearing event, and it's now moving up to more. But hey, that's a total speculation. I haven't got a clue. Yeah. Okay, let's move to stay in the software or technology. We've got a question from Adrian DeMade. He's asking about Corero network security, which we have never talked about. I think it does denial of basically prevention devices that stop websites being blasted by distributed denial services.
Yeah,
I can't remember exactly what it's called, but essentially it stops them being overloaded by all these sort of computers being pointed towards it. Seems to have now really turned a corner, actually.
Well, this hasn't reported recently, so I'm not. I haven't covered this because I only do the day's news. But the last comment I did on Corero was in 1st of April. Oh, that's a month ago. Yeah, it put out its 2024 results, which were in line. Doesn't really make any money. That's the only problem. Only 0.6 million PBT dollars. Next to nothing on the balance sheet. So I just concluded it looks very expensive and that it needs to grow a lot to justify this valuation. So obviously, I mean, do you know what the because it's about 86 million, or it was 86 million market cap back in a month ago. I don't see the value in it personally. So is it a bit jam tomorrow? Have they got some?
No, it's been around for a long time, and therefore its product has obviously got something. It teamed up with Jupiter Networks about 5 years. Juniper, that's right. Juniper, not Jupiter. Yeah, Juniper. About 5 years ago, and they've been selling through. And if that relationship still is doing well, which it sounds as though it is, then it looks as though they've got a best-in-class point solution for cybersecurity. And you do get these occasional sort of like gems that have, again, point solutions that get bought out for very big numbers. And if Juniper decided to never do that, then I could understand why the valuation has gone up. But I don't know as much. I genuinely thought sort of 5 years ago the technology was going to get sort of overtaken by the Americans, but the chart says to me it isn't. And if Juniper still is backing it and selling it, then I can really understand the strategic value of the business, to a potential third party.
You could be right. I mean, to me, as just purely a fundamentals-based value type investor, I can't see anything at all in it. So. But that's not to say that people are wrong. They might have seen something exciting about the products and all the rest of it, which is kind of a different layer, isn't it, of the investing side of it. But I've not seen anything that interests me.
Yeah. Okay. We've got a question from Stefan. He's asking about Focusrite. Is that the audio and video sort of professional equipment to provide? Really tough sector. I mean, you saw Vivendum coming up with a bit of a distressed fundraise this week in sort of like videos and stuff like this. So let's go to Focusrite first. Really, really tough area at the moment.
Focusrite, yeah. Now, my colleague Dave uses the products. He knows the company very, very well, and he said to me that, and the readers, that Focusrite's products are absolutely best in class. He said, when you talk to professional creators and musicians and whatever, they will, they basically say, don't even bother looking at the competition. Focusrite stuff is top notch, which is good. But the problem is the figures have not been top notch. It had I think a massive pull forward of demand in the pandemic. People were stuck at home. A lot of people turned to producing and making their own music and podcasts and all the rest of it. That's what these products are mainly used for. The market wrongly and the company wrongly thought it was structural growth, which it wasn't. Same with a lot of pandemic boom stocks. It was just pulling forward demand, which they've had a terrible hangover. And look how far down the shares have gone. They've lost, I think, over 90% of their value. We're on the cusp of turning moderately positive on this. We thought the most recent update, it's not come through on my system. I think it was only a day or two ago from Focusrite. We thought there was sort of green shoots there. It looks like it's over the worst. It's been through a destocking phase. So there was some interesting potential positives there. And of course, it used the cash flows during the pandemic to buy up some other music related businesses. So it's got a more diversified product range. So I think it's coming into buying range, but I've said that several times down that ski slope over the last 3 years. So ignore me on this because I'm no good at calling the bottom, but I think it might be getting near the bottom, and the debt did rise, but not to dangerous levels. And I think it's okay balance sheet wise. So yeah, I would urge people to have a look at Focusrite. It's starting to look potentially a bargain, I think. So have you looked at it, Paul?
No, not in great detail. I just think it's a really tough area, selling audio and visual equipment into, maybe professional markets. Yes, it's top notch. It's got great brands, but frankly, the Chinese are coming for this industry. And disruption with tariffs. I think you've got to be an expert to really understand this one and what its pricing power is going to be like going forward, and the margins and all that kind of stuff. Consumer electronics, I know it's not, it's professional electronics, but it can be a tough area, tough gig, that area, the whole sector.
Yeah, and that's just triggered something that I remembered now, actually. The other thing is make sure you look at the cash flow statement, because Focusrite spends a huge amount on product development, which it capitalizes. So, which means that EBITDA, of course, doesn't capture the product development costs or the amortization. It bypasses EBITDA altogether. So this is a stock where EBITDA is hugely inflated compared with what reality is. So just bear that in mind if you're looking at the numbers. Do look at the cash flow statement. I still think it's an interesting company, though.
Yeah. Okay, we can just change the sector. We've got a question from Rebecca. She's asking about Restore, which is a sort of paper archiving business. That's part of it. It sort of like takes public sector documents, stores them underground, I think into air raid shelters or bomb shelters or something like that.
Salt mines as well.
And it's also got a technical business that helps destroy old electronics, computers and stuff securely. The original owners come back. Rebecca says he's doing a great job. Guy called Charles Skinner, and the Harwood guys are in the share register as well. Don't know if you had a look at this one, Paul?
Not recently. I don't think it's reported recently, has it? So I don't think I'm up to date on Restore. Let's just quickly bring it up. I get this muddled up with RWS, the patent thing. Forward Restore is on a forward P of 10, 3% dividend yield, but it's got quite a negative balance sheet. I think this is the one where the previous management went on an acquisition splurge, and it didn't work, did it? They really messed up with some of the acquisitions, and I think, I think you're right. Didn't you just mention that the previous CEO came back?
Yes.
So it's a sort of back to basics type of thing where they're undoing. The shares are sort of trickling along sideways, aren't they? No strong view from me. What's your? Do you think it's good, Paul?
I think they've got good recurring revenue streams because they're long-term contracts with the document storage. There's very few competitors in it. You've got to look at the sort of what is the growth, though. I mean, they've got a very defensive business. They're going to improve margins and do lots of self-help and generate lots of cash, which is great. It all comes down to whether somebody can buy this, and I think that's where the Harwood guys are. They've put a multiple of EBITDA on what they think something like Iron Mountain might come knocking on their door when Charles. But it isn't something I would personally go to. But hey, the Harwood guys typically know what they're talking about, and if Rebecca's mentioning it, then she's had a good look, and it's definitely worth flogging to people to stick on their stock watch list, I think.
Yeah, well, Rebecca is very shrewd as well. So, maybe that's one we should have. I mean, we always look at these things on my Substack whenever the results and trading updates come through. It's just that I don't think there's been anything recently. So, the last update was, 21st of November. That was the trading update. I don't think we've had anything since then. We must be due something soon. So I'll make sure I do a write-up on it when Restore next. Rebecca's one of my subscribers, so she'll see that. So
good. Okay.
Harwood Capital 11.2%. That was in mid-March. So Harwood is still buying. Yeah.
Okay, let's move just on the healthcare life science. We've got Cambridge Cognition, which does a lot of the sort of the clever sort of like computer tests and stuff for people who have got dementia or brain problems, Alzheimer's and stuff like this. They've gone through a really tough patch of late, but they just came out with a trading update this morning saying their order book increased quite significantly in the first quarter, and they believe going forward that it's going to carry on improving, which is mean they're winning sales in this quite tough environment. The shares traded about 1 time sales for a high margin life sciences business. Looks cheap.
Yeah, I've followed this one for many years, and I've kind of given up on it because the problem is, in my opinion, it's too small a niche.
Yeah.
They're undoubtedly world-class experts in this niche of cognitive testing. They've got decades worth of very valuable data on it. Limited competition. I think the only main competitor is some Australian company which does something similar. But they had a very nice turnaround under a new CEO called Stork, I think it was, who did a massive turnaround on it. And we caught that, actually, that really big move in 2020. It sort of, nearly 10-bagged. The trouble is it's come nearly all the way back down again. And it's because fundamentally they can't scale it up. Yeah, it's a modest, small niche. The story, well, the reason it 10-bagged was that this was now going to be used routinely in all other drug testing. Not just related.
Yes, that's
health.
right.
Yeah, but I mean, you can see from the chart it hasn't worked. I'm not really interested in revisiting this story. So, but good luck to people. It might work out. I think the latest update showed it's still loss making.
Yeah, I personally am a bit more positive. I mean, they do indicate that there's potential to deliver sort of 75 to 100 million pounds worth of high margin orders, and they wouldn't be saying that unless they had some basis behind it. And the order book is increasing. So I don't know. If somebody's an expert in this, I would definitely be interested in running the slide rule. The problem I have is liquidity. I don't think I'd be able to put get a reasonable position. Not that much money.
I think you find there are plenty of sellers happy to.
Yeah, no, you could be right. You could be right.
The problem will be when you want to sell.
Yeah. Okay, I'll be a bit remiss of me not to mention we've had a couple of good, encouraging numbers from the house builders this week. We had Taylor Wimpey and Persimmon. You got Taylor Wimpey 1 times book. You've got Persimmon 1.2 times book. Both saying they're maintaining expectations. They haven't been disturbed by the gibber. What's your view? These seems like good, secure, sort of like businesses. These.
This is a great entry point for the house builders. I think you will almost certainly now, because we've had evidence from a lot of them over a good, decent length of time now, to say that we are almost certainly at bottom of the cycle earnings now. Yeah. And the earnings are going up. They're all confirming this in the latest updates. Interest rates are coming down, which, 0.5% off mortgage rates would stimulate, I think, a stampede of buyers. Yeah. I think this is a fantastic time to be looking at house builders. As you say, a lot of the bigger and better ones are now almost at par with book value because you can see from the chart there, they've sold off a lot. It doesn't make sense. I think because of all the macro is now going in their direction too. People won't pause buying a house because they're worried about Trump. There are 2 things: it's the affordability of the mortgages, and it's whether they feel secure in their jobs. And if they tick those 2 boxes, British people will are desperate to buy houses. So I think the house builders is a fantastic sector to be looking at the moment. I'm probably going to just buy a basket of them. 4 or 5 of them. They're all fairly similar. Also, I think fund managers. I think I've gone bullish on that sector this week. I think now is the time to be looking at the best fund managers. There's some amazing bargains there. Yeah.
Just on that, Paul. Before we close it, what about Aberdeen? Because it came out with a trading update. They're trading at. I remember the 0.6 of book. 10% dividend yield and 12 PE. I mean, what are we missing? It just seems like the most sort of like standout purchase you could put for a really big asset manager as well.
Yeah, that one is top of my list to buy of the fund managers. I haven't got any spare cash at the moment. I totally agree. 10.3, 10% yields. We've been green on it all this year. We just think it's a standout, obvious bargain. The only thing is the balance sheet is huge and it's very complicated. It's got quite a lot of stuff in there that I don't really fully understand, but you are buying it. And I think the most recent update this week was a very small net cash outflow, net fund outflows. I think it's got about 500 billion of funds under management, but it was nearly all the outflow was due to one 4 billion fund that was a single customer, a single mandate that lost. So I think the underlying side, they're also doing a huge amount of cost cutting. I think they said they're going to strip out 150 million per annum cost. So they seem to be very proactively pushing their margins up. That 10% dividend yield is sustainable, I think. Yeah. So yeah, I think Aberdeen's fantastic at the moment. Not talking my own book, I don't hold it personally, but I think it's Jupiter is the other one I really like, JUP. That is 60% of the market cap is its own net cash.
Yeah.
So you're paying next to nothing. The ones I'm avoiding are the ones with the 18 and 20% dividend yields, because I think those are structurally in trouble. Their funds are third and fourth quartile, and they're just seeing an exodus of money. So those dividends won't be sustained, and you may not have a business in 5 years' time. So I think going for the extreme dividend yields is gravitating towards where the biggest problems are, I think.
Yeah, no, I would go for Aberdeen if I was choosing a fund manager every day of the week. It absolutely looks rock solid, and it looks the optics and the financials looks great. We got another one you own, I think, who came out with a trading update or numbers was Whitbread, the Premier Inn owner. They dropped their profit dropped according to it 14%, but the shares are up 5%. What's happened?
I looked at that this morning. It was actually a slight earnings miss. It wasn't very much. It was about 3% below consensus forecast. The main business is Premier Inns, and it's also expanding Premier Inns into Germany, which is approaching break even now. I think this new financial year, it's a February year end, so the 26 year end is the first year that Germany should contribute a positive contribution. Very, very well run business, I think. You know what you're getting with Premier Inns: a comfortable bed, reasonable facilities, and a nice breakfast at a reasonable price. It's that simple. It's brilliant. And there's very little branded competition, you see. And now the metrics that I went through this morning, PE is 12. The profits are kind of flatlining at the moment, but they're up. They jumped a lot in the last, and a couple of other hotel groups have recently said, business is not that good. You've also got a standout bulletproof balance sheet, 3.3 billion net tangible asset value, which is nearly 70% of the market cap. So they own all these freeholds. They've got hardly any debt, only 480 million financial debt, which is only half EBITDA. You ignore the leases, you see, and they're going to do 2 billion in buybacks and dividends over the next 5 years. Yeah, it's fabulous. It's unfortunately we've missed that recent low, but I think even now, I think Whitbread's a terrific share at a very reasonable price.
Yeah,
you look at, Paul?
Yeah, no, I like it. I always go to Premier, and it's my go-to sort of like.
Me too.
And you just say everybody talks about the breakfast, but the thing which really sort of stood out to me is that it does seem as though their German expansion is in profitability, which I think they said this morning, and that's fantastic. I think
it's not yet, but it is going to be in the current
year. And that's taken the risk off, because people can start seeing this model being lifted and shifted from the UK into a more competitive market, where they thought maybe there's a chance that that's going to have to exit later on. But it looks as though they've got the beachhead and it's growing and it's going to be profitable. It's there for full, so for full line. So I think it's really good.
Yeah, I do. And I like their self-help measures as well. They've said, look, we're going to have to pay all this extra employers NI. This is what we're doing to mitigate it, blah, blah, blah. And they've done things like they have co-located restaurants and bars that they also own. They've said to the ones that aren't performing, right, just turn them into more hotel rooms. So they're being quite proactive on utilising their space well. And the only thing I found mystery shopping at Premier Inns is that the self-check-in kiosks are often broken.
Are they?
Yeah, when I've been, maybe it's just me, maybe I put too much static electricity when I press the buttons, but yeah, it's been pandemonium on reception on the occasions I've been there. So I think operationally maybe they've got a few issues, but yeah.
I think it's fine. Okay, final one. We've got it's a bit of a sort of one for the brave, Carclo, which does sort of like precision parts for all kinds of industrials, and I think did for a bit for cars and all kinds and medical, etc. It's a quite popular share given how it's still quite small, going through a big turnaround. Kind of, I think, a bit of a pension and a bit of debt and stuff. What's your view? Is this one for the brave, or this is?
It is one for the brave. I think this is an interesting trade, actually. I mean, I've been through this in a lot of detail this week and last week. So see my Substack for the articles on that, where I've gone through it with a fine tooth comb. Basically, you're absolutely right. The big issues are it's got a lot of debt. However, that is offset by freehold property, which maybe not everyone realizes. And also, it's got a giant pension scheme. Yes, the deficit has come down by 20% or something, but where they've just done a refinancing on the bank debt, they haven't disclosed the terms, so we don't know. They're kind of being cagey with the information, trying to get the shares up, I think, by bullish talk in the most recent trading update, but light on specifics. Now, this is another operating margin improvement story. If they can achieve the desired operating margins, these shares are going to fly. You know, this will be a multi-bagger. But again, I just caution, we don't know if they're going to be able to deliver that yet. It's not clear, but very interesting trade, I think. And I wouldn't, for people who accept a bit of risk, I would say actually now is not a bad time to have a flutter on this, because they've just refinanced the debt, you see. Even though we don't know the terms, at least you don't have to worry about the lender pulling the plug or anything like that. So not a bad little pump, Carclo, I think, for the brave.
Yeah, the one thing I would have a look at if I was sort of considering a position in it is what percentage of the business is contract manufacturing compared to their own design manufacturing. If it's design manufacturing, they've got a much better chance of passing pricing on. If it's contract manufacturing, it's much harder. I mean, you get that. The same thing happens with, obviously, you know, all the supermarkets. You know, if you've got your own brand, you can charge a better price than if it's a supermarket own brand and you're applying the inside. The same things on this one, but no, interesting trade. That's for sure. Yeah,
I think you could put a stop loss in, or you could just you've got to bear in mind though, there's a ton of traders in this. So when it peaks, it shoots up, and then when it peaks, they all run for the exit at the same time. So I don't know if you're able to zoom out on the chart there, Paul, but I mean, it's had some spectacular speculative rallies, you know, where it's 10 or 20 bagged, but then it just goes all the way back down again. So you've got to treat this one don't fall in love with it, I would say. Just treat it as a trade. And if you time your buys and sells, luckily, you can make a bob or two. So
it peaked at £4.67 in September 2012. So 2012, and so it's about tenth of that at the moment. But anyway, got a final question for you from Andy 2205 there, Paul. He's asking, can he get a free pen at Mello if you're going to be there?
Oh, how did you know about that?
I know. He's obviously a subscriber for you, isn't he? He's looking for some free pens.
Well, I want a dual purpose, as always. I wanted to try out 4imprint because I've just bought some shares in 4imprint. So I've ordered 500 pauliepilot.substack pens, and I'll be at Mello giving them away. So I've got 500 to get rid of. So some people might have to take several.
Well, here's anybody who wants to be who isn't a subscriber and wants to be a subscriber and goes to Mello, then if you get a pen off Paul, then you've got to subscribe. That's the sort of the agreement, okay?
Well, I've got a team of writers now, so I need to drum up.
Too right. It's excellent.
Got 4 of us now, but obviously the guys need paying, so I'll have to do a bit of promotion.
Yeah, true. All right, brilliant. Well, thanks again, Paul. Fantastic comments. Got a long weekend, which is great. Everybody can sort of put their feet up, have a nice glass of prosecco in the garden, watch the final of the snooker, probably.
Yes,
if you're that way inclined. And same time, same place on this same channel at 2:00 on next Thursday. So thanks again, guys. Cheers.
Yeah,
Paul.
thanks everyone. Thanks, Paul.